Right now, somewhere in America, someone just got paid. And within 72 hours, that entire paycheck will be gone. Rent, groceries, subscriptions, maybe a little extra on a credit card bill. And at the end of the month, the balance in their savings account looks the same as it did last month. Close to nothing. But here's the thing. It's not because they don't make enough. It's because nobody ever taught them the right order to do this. See, most people think investing is just about picking the right stock or finding the next big thing. But the real secret that separates people who build wealth from people who stay broke is simpler than that. It's sequence. The order in which you deploy your dollars changes everything. Get the sequence wrong, and you're basically running on a treadmill. Get it right, and every single dollar you earn starts pulling double duty. The first place every single dollar should go, before investing, before retirement accounts, before anything else, is an emergency fund. I know, it sounds boring, it sounds basic, but without this, everything else falls apart. One flat tire, one surprise medical bill, one layoff, and suddenly you're pulling money out of investments at a loss, or worse, stacking up credit card debt at 20% interest. Your emergency fund is not an investment. It's a shield. It protects every other financial move you make. Once that shield is in place, step 2 is your employer's 401k match. If your job offers a 401k with an employer match, this is the single highest return investment available to you on planet Earth. A typical match is 50 cents on the dollar, up to 6% of your salary. That is an instant 50% return on your money before it even touches the market. If you're not contributing enough to get the full match, you are literally leaving free money on the table every single pay period. Step 3 is where most people's eyes glaze over, but it might be the most important move of all. Pay off high-interest debt. If you're carrying credit card balances, personal loans, or anything above 7 to 8% interest, that debt is a financial emergency. The average credit card rate in America right now is hovering between 20 and 24%. That means every dollar sitting on a credit card balance is costing you nearly a quarter of its value every single year. No investment consistently returns 20% per year. The S&P 500 averages about 10% historically. So when you pay off a credit card charging you 22%, you're effectively earning a guaranteed 22% return. That's the best deal in personal finance, and most people walk right past it. Now, once your high-interest debt is eliminated, step 4 is the Roth IRA. A Roth IRA lets you invest after-tax dollars, and then everything it earns, every single penny of growth, is yours. No taxes when you withdraw in retirement, no taxes on the gains, nothing. In 2026, you can contribute up to $7,500 if you're under 50, or $8,600 if you're 50 and older. You can invest in index funds, ETFs, individual stocks, whatever fits your strategy. And because you've already paid taxes on the money going in, the government never touches it again. If you start a Roth IRA at 25, contribute the max every year, and invest in a broad market index fund averaging 10% returns, by 65, you're looking at well over $1.8 million. And you won't owe a single dollar in taxes on it. Step 5 is the Health Savings Account, or HSA, if you're eligible. An HSA is available to anyone enrolled in a high-deductible health plan, and it comes with a triple tax advantage that no other account in America can match. Your contributions are tax-deductible, your money grows tax-free, and your withdrawals for qualified medical expenses are tax-free. In 2026, you can put in up to $4,400 for individual coverage, or $8,750 for a family plan. But here's the real power move. You don't have to spend your HSA money now. You can invest it, let it grow for decades, and use it for medical costs in retirement. After age 65, you can withdraw HSA funds for any purpose and just pay normal income tax, which makes it function like a second traditional IRA with extra benefits. Stacking a Roth IRA and an HSA together creates a nearly untouchable retirement combination. Step 6. Now we come back to your 401k, and this time we max it out. You've already contributed enough to capture the employer match. Now push it all the way to the $24,500 limit. This reduces your taxable income dollar for dollar, which means you keep more of what you earn today while building serious wealth for tomorrow. If your employer offers a Roth 401k option, even better. You can split contributions and diversify your tax exposure in retirement. Step 7 is the Taxable Brokerage account. Once you've maxed out every tax-advantaged account, the next level is a regular brokerage account with no contribution limits and no restrictions on when you can access your money. This is where you build wealth beyond retirement. Low-cost index funds, like a total stock market fund or an S&P 500 fund, work perfectly here. You'll pay taxes on dividends and capital gains, but the flexibility is unmatched. And finally, Step 8, which is optional but powerful. If you have children or plan to, consider opening a 529 education savings plan. Contributions grow tax-free, and withdrawals for qualified education expenses are also tax-free. It won't help your retirement, but it prevents future education costs from destroying the wealth you've built. That's the full sequence: emergency fund, employer match, high-interest debt, Roth IRA, HSA, Max 401k, taxable brokerage, 529 plan. Follow this order, and you are not guessing. You're not hoping. You're engineering wealth with precision. Every dollar you earn now has a job, a destination, and a purpose. And the earlier you start this sequence, even if you start small, the more powerful it becomes. But then, something strange happens. You start doing everything right, and it still feels like you're falling behind. Because while you're building your money with purpose, the world around you is putting on a completely different show. You open Instagram, and there it is. Your coworker just posted photos from Tulum. Your neighbor pulled into the driveway with a brand new SUV. Your old college roommate is renovating their kitchen for the second time in 3 years. And you're sitting there thinking, what am I doing wrong? Why does everyone seem to have more money than me? Here's the truth that nobody talks about. They probably don't. What you're seeing isn't wealth. It's a performance. And today, I'm going to pull back the curtain on why you feel broke, even when you're not, and what to do about it, starting right now. Let's start with the numbers, because the numbers don't lie. Total U.S. household debt just hit $18.8 trillion at the end of last year. Credit card balances alone reached $1.28 trillion. The average American with credit card debt owes around $7,886, and the median savings account balance for American families is just $8,000. That means half the country has less than that sitting in the bank. So the next time you see someone driving a $60,000 truck or carrying a designer bag, understand something. There's a very real chance that purchase was financed. You're comparing your bank account to someone else's credit limit, and that comparison is destroying your peace of mind. Think about that for a second. If the average household owes over $105,000 in total debt and only has $8,000 saved, That means most people around you are operating deep in the negative. The cars, the clothes, the brunches, the trips, they're not signs of wealth. They're signs of borrowing. And borrowing always comes with a bill, usually at 24% interest. So what looks like abundance on the outside is often anxiety on the inside. You just never get to see that part. There's actually a name for this now. Researchers call it money dysmorphia. It's like body dysmorphia, but for your finances. A Credit Karma study found that 29% of Americans experience it. That's nearly 1 in 3 people who have a completely distorted view of their own financial situation. They feel broke even when they're stable. They feel behind even when they're doing okay. And if you're in that group, I need you to hear me. The problem isn't your wallet. It's your lens. So, where does this distorted lens come from? Social media. And I don't mean that as a throwaway answer. I mean it structurally. Your feed is an algorithm designed to show you the top 1% of everyone's life. Nobody posts the overdraft notification. Nobody shares a story about the $247 minimum payment they can barely make. You only see the vacation, the car, the house, the ring. A study from the Money and Mental Health Policy Institute found that social media pressure to spend is the single biggest factor damaging people's financial well-being. Not income, not bad luck, the pressure to match what you see online. And it gets worse. This pressure triggers something psychologists call upward social comparison. You're not comparing yourself to the average person. You're comparing yourself to a highlight reel. And when you do that over and over, day after day, it rewires how you think about money. You convince yourself that more money means more worth. That belief pushes you to spend just to keep up. Now, let's talk about the trap that catches people who actually do start earning more. It's called lifestyle creep. Your income goes up $500 a month, and within 60 days, your expenses go up by $500 a month. The car gets upgraded, the apartment gets bigger, the vacations get fancier. A Fortune report found that even workers earning over $500,000 a year are living paycheck to paycheck. That tells you something important. The problem was never about how much you make. It's about the gap between what you earn and what you keep. And most people keep almost nothing. About 26% of Americans say they regularly spend more than they earn. That's more than 1 in 4 people actively going backwards every month while looking like they're moving forward. They've got the new clothes, the dinner reservations, the subscription boxes. But behind it all, debt is stacking up, savings are shrinking, and stress is building in silence. So, how do you break out of this? Let me give you 3 shifts that actually work. Shift number 1. Track your net worth, not your income. Your income is what comes in. Your net worth is what stays. Start writing down everything you own minus everything you owe, and update it once a month. When you focus on that number going up, your whole behavior changes. You stop chasing appearances and start building something real. Shift number 2. Build a 48-hour rule for non-essential purchases. You see something you want? You wait 48 hours. If you still want it and it fits your budget, fine. But most of the time, the urge fades. That's because most spending isn't driven by need. It's driven by emotion. And emotions pass. Shift number 3. Curate your inputs. Unfollow accounts that make you feel behind. Replace them with people who teach you about building wealth, managing debt, growing your savings. What you consume shapes what you believe, and what you believe shapes what you spend. Here's the bottom line. The reason everyone seems to have more money than you is because you're watching a magic trick. You see the spending, but not the debt behind it. You see the lifestyle, but not the stress underneath it. You see the result, but not the 3 maxed-out credit cards making it possible. Your job isn't to match what other people show. Your job is to build what other people can't see. Savings, investments, low debt, financial margin. That's where real freedom lives. Not in a leased car, not in a financed kitchen. In the quiet confidence that you can handle whatever life throws at you, because you built a foundation instead of a facade. And even when you build that foundation, most people still get one thing wrong. Not because they don't care, but because no one tells them what actually happens once they start investing. The truth is, building wealth isn't just about what you do with your money. It's about what you avoid doing. There's a number I want you to hear, and once you hear it, you can't unhear it. In 2024, the average equity investor underperformed the S&P 500 by 8.48 percentage points. The market did its job. The investors didn't. And that's not a one-time fluke. Dalbar has tracked this gap since 1985, every single year. Same story. The market gives, investors give it back. So today, we're ripping off the Band-Aid. These are the uncomfortable truths about investing that nobody wants to tell you, but you absolutely need to hear if you want to build real wealth. Let's start with the big one. You are the biggest threat to your own portfolio. Not the economy, not inflation, not the president. You. According to J.P. Morgan, over one long 20-year stretch, the S&P 500 returned around 10% per year on average, but the average investor earned just 2.9%. Same market, same opportunities, wildly different results. And the reason is behavior. People panic sell when the market dips. They pile in when prices are already sky high. They chase hot tips from coworkers and strangers on the internet. Then they wonder why their account is bleeding. Here's the second truth that stings. Doing nothing is not safe. A lot of people say, I'm just going to keep my money in the bank. At least it won't lose value. But that's a lie your brain tells you because it feels safe. Right now, U.S. inflation sits at 2.4%. That means every single dollar you leave sitting in a basic savings account is quietly shrinking. $1 million in 2015 now needs $1.32 million to buy the same things. That's a 30% loss in purchasing power in just 10 years. You didn't spend it. You didn't invest it. You just let it sit there, and it rotted like fruit on a counter. The uncomfortable truth is that cash feels safe, but it guarantees you lose money slowly. The only question is how much you're willing to lose by standing still. The third truth is about timing. You don't need to find the perfect moment. You need to stop waiting for it. Here's what the data from Capital Group actually shows. If someone invested $10,000 at the absolute worst time every single year, picked the market peak every year for 20 years, they'd still end up with an average annual return of over 12%. Waiting on the sideline cost more than buying at the worst possible time. Let me say that again. Being in the market at the wrong time still beat being out of the market entirely. But millions of people are sitting on cash right now, waiting for some magical green light that never comes. They're watching TikTok, reading headlines, refreshing stock tickers, and convincing themselves that research is the same thing as action. It's not. Research without execution is just procrastination wearing a smart disguise. And that connects straight to truth number 4. Time is worth more than money. Most people think investing is about picking the right stock. It's not. It's about giving your money time to compound. Someone who invests $200 a month, starting at age 25, at an average return of 8%, ends up with roughly $700,000 by age 65. But if they wait until 35, same amount, same return, they end up with only about $300,000. 10 years of delay didn't just cost them 10 years of contributions. It cost them $400,000 in compounding. That's the part nobody tells you. You're not just losing what you don't invest, you're losing what that money would have earned on top of itself for decades. Now, here's the 5th uncomfortable truth. Most people think they'll catch up later. According to Bankrate's 2025 report, 58% of American workers say their retirement savings are behind where they should be, and 54% of American households have no dedicated retirement savings at all. That's not a small gap. That's a crisis happening in slow motion. And the reason is always the same. People tell themselves they'll start next year. Then next year becomes the year after. Then a decade passes. And suddenly, the math doesn't work anymore. Less than half of people currently saving for retirement are even on track to maintain their current lifestyle, according to Vanguard's latest data. That means even the people who started are falling short. So, if those who took action are still behind, imagine where you'll be if you haven't taken any action at all. Truth number 6. Diversification isn't exciting, and that's exactly why it works. Your brain wants the thrill of the moonshot stock, the one ticker that goes 10x. But JP Morgan's own 2026 outlook warns that concentration risk is rising. When you bet everything on one sector, one stock, or one trend, you're not investing, you're gambling with your future. The boring, balanced portfolio of index funds spread across sectors and asset classes has outperformed the vast majority of professional fund managers over 20 years. In fact, 92% of large-cap fund managers failed to beat the S&P 500 over that period. So, if the pros can't do it, what makes anyone think they'll outsmart the market by day trading on their phone between meetings? And the final truth, the one that ties everything together. The market doesn't care about your feelings. It doesn't care if you're scared. It doesn't care if you're excited. It doesn't care if you just got a raise or just lost your job. It moves based on earnings, economics, and the collective behavior of millions of participants. And the people who build wealth are the ones who stop trying to control what they can't and start controlling what they can. That means automating investments. That means ignoring the noise on social media. That means setting a plan and sticking to it, whether the market's up 20% or down 20%. It means treating your brokerage account the way you treat your electric bill. You don't debate whether to pay it this month. You just pay it. Make investing that automatic, that non-negotiable, and you remove the emotions that destroy most portfolios. Here's the bottom line. The uncomfortable truth about investing isn't that it's complicated. It's that it's simple, but emotionally hard. And most people lose not because they don't know what to do, but because they can't stop themselves from doing the wrong thing at the wrong time. If this hit home, subscribe to Frankie Finance. We break down the money truths that actually move the needle. No fluff, no hype. Just the real talk you need to hear to take control of your financial future. Hit subscribe, turn on notifications, and I'll see you in the next one.